Imagine waking up one morning to a world in financial chaos, stock markets in freefall, banks teetering on the brink of collapse, investors panicking, and ordinary people scrambling to protect their savings. Now, imagine realizing that you could have known this was coming weeks, months, or even years earlier, because gold and silver, the timeless guardians of wealth, had already started signaling danger, while the rest of the world remained blissfully oblivious. Today, we're diving deep into why these precious metals consistently react before financial crises officially hit. Why they are more than just shiny metals, and how paying attention to their movements can give you a massive advantage in protecting your wealth. Gold and silver are not merely luxury items or jewelry, they are ancient financial instruments, trusted across cultures and civilizations for thousands of years. And they serve as real-time barometers of trust, fear, and economic stability. Unlike stocks, bonds, or real estate, their value isn't dependent on corporate earnings or government promises. They are tangible, portable, and universally recognized stores of value. When uncertainty creeps into an economy, when central banks start printing money aggressively, or when governments rack up unsustainable deficits, sophisticated investors and insiders often turn to gold and silver first. This creates a subtle but powerful ripple effect. The metals begin to rise long before panic spreads to the mainstream. Let's look at history for proof. During the 2008 global financial crisis, for example, gold prices had already started climbing steadily in 2006 and 2007. Investors were quietly reacting to systemic risks. Banks were mortgage-backed securities were overinflated, and the housing bubble was reaching unsustainable levels. While most of the public was oblivious, those paying attention to precious metals had an early warning of the storm brewing. Silver, too, surged in anticipation, driven both by financial anxiety and by its dual role as an industrial metal. The pattern repeats itself across decades. In the 1970s, when inflation surged due to oil shocks and reckless monetary policies, gold climbed long before the crisis was fully recognized. During the Great Depression, people flocked to gold as banks failed and paper money lost trust. Even further back, during periods of war, hyperinflation, or government default, silver often acted as a leading indicator of instability, reflecting real fear and loss of confidence before governments and mainstream markets officially acknowledged the problem. But why exactly do gold and silver react ahead of other assets? It comes down to three critical factors: trust, perception, and liquidity. First, trust. Gold and silver have intrinsic value that transcends borders, governments, and political systems. When people lose confidence in paper money, banks, or financial institutions, they turn to these metals because they hold value no matter what. This behavior starts quietly, but it impacts prices as early as the first wave of risk recognition. Second, perception. Precious metals are often purchased by insiders, large investors, and global institutions who are closely watching systemic risks. They don't wait for official reports or media headlines. When these entities sense instability, their buying creates subtle price movements that precede mainstream recognition. Third, liquidity. Gold and silver are traded globally, 24/7. Even small shifts in demand in one part of the world, say in Asia, Europe, or the Middle East, can influence prices elsewhere. This creates a real-time decentralized early warning system that often reacts faster than national stock indices, inflation reports, or economic statistics. And it's not just psychology, it's also mechanics. Large financial institutions, hedge funds, and central banks monitor these metals closely. When they anticipate instability, they hedge by increasing exposure to gold and silver, pushing prices upward even before the general public perceives danger. Silver, in particular, has a unique dynamic. Unlike gold, it has dual utility. It is both a store of value and an industrial commodity used in technology, electronics, energy, and manufacturing. This means it reacts to both economic uncertainty and actual industrial demand. Historically, during crises, silver often moves faster than gold, offering an even earlier signal of impending turmoil. But let's go beyond numbers and trends. Why do these metals have such predictive power? The answer lies in human behavior. Throughout history, during periods of calm, people become complacent. Stability makes us feel safe. and we start taking risks we normally wouldn't. We borrow, speculate, and leverage our positions, convinced that markets will rise indefinitely. This optimism feeds bubbles in housing, stocks, commodities, or even crypto. But insiders and sophisticated investors are often more cautious. They see the subtle accumulation of risk and act accordingly. They buy gold and silver quietly, long before fear becomes widespread. This behavior explains why precious metals often rise before a crisis hits the mainstream headlines. For example, in the months leading up to the 2008 collapse, hedge funds and wealthy investors were quietly accumulating gold and silver, recognizing that credit expansion had gone too far, that leverage ratios were unsustainable, and that housing and financial markets were dangerously ordinary investors, distracted by a rising stock market and media reassurances, were blindsided when the crash arrived. Paying attention to gold and silver isn't just about buying metals. It's about reading the market's subconscious signals before the chaos hits. Another aspect to consider is the macroeconomic environment. When central banks inject liquidity into the system, when governments run massive deficits, or when interest rates remain artificially low, risk-taking increases. Investors start chasing yield and ignoring fundamentals. In this environment, gold and silver act as stress gauges. When they start rising steadily, it often reflects rising systemic risk long before other assets react. And it's not just modern crises. During the 1970s, inflation and oil shocks caused gold to soar before ordinary Americans felt the pinch. During the Great Depression, the rush to gold occurred before the full impact of bank failures and unemployment hit the public consciousness. Even in emerging markets, gold and silver respond to political instability, currency devaluation, or sovereign debt crises before stock markets fully price in the risk. For the everyday investor, this is powerful information. By monitoring gold and silver trends, looking at price momentum, trading volumes, and relative strength, you can gain insights into underlying economic stress that aren't yet visible in traditional indicators like unemployment rates, GDP reports, or stock indices. Moreover, the interplay between gold and silver can reveal even more nuanced signals. If gold is rising steadily while silver lags, it might indicate systemic financial stress. If silver surges faster than gold, industrial or supply chain disruptions might be playing a larger role. Understanding these patterns allows investors to prepare strategically, not react emotionally. Now, let's talk about how you can apply this knowledge in practical terms. First, don't wait for crises to be officially declared then it may be too late. Start paying attention to precious metals as part of your early warning system. Look for steady price increases, rising volumes, and unusual trading activity. Second, diversify your approach. While gold and silver are essential, consider them as part of a broader portfolio that includes cash reserves, low-risk, bonds, and other safe assets. Third, understand the broader economic context. Rising debt levels, central bank stimulus, inflationary pressures, geopolitical tensions, and over-leveraged markets all amplify the predictive power of precious metals. Finally, remember that these metals aren't perfect. Prices can be influenced by speculation, short-term political events, and market manipulation. The key is pattern recognition. Repeated historical behavior shows that gold and silver act as leading indicators, not exact predictors, and that's why studying them is invaluable. By recognizing trends early, you can protect your wealth, hedge against uncertainty, and even find opportunities to profit when the broader market reacts too late. Precious metals don't lie. They reflect collective trust, fear, and risk, often long before conventional financial systems acknowledge the problem. In today's hyper-connected world, with central banks printing trillions, debt levels at record highs, and geopolitical tensions simmering, gold and silver are more relevant than ever. They move before crises because they capture the subtle, cumulative anxiety of insiders, investors, in global markets. Understanding their signals isn't just interesting, it's essential for anyone who wants to navigate an increasingly volatile economy. So, the next time you see gold quietly climbing while stocks are still stable and the news seems cheerful, remember, the market often whispers before it screams, and gold and silver are some of its loudest whispers. And if silver starts accelerating even faster, pay even closer attention, because it often indicates industrial stress or a looming systemic event. By observing, analyzing, and learning from these patterns, you give yourself a critical edge. You gain the ability to protect your wealth, make informed decisions, and anticipate the next financial storm rather than being blindsided. In short, gold and silver are not just investments, they are a living record of market psychology, economic fragility, and human behavior. They react before crises, are official because they are trusted, liquid, and universally recognized as stores of value. They embody fear before it becomes panic, and wisdom before it becomes hindsight. And in a world where financial uncertainty is the new normal, understanding these signals can be the difference between financial security and regret. So pay attention, study the charts, understand the psychology, and remember, when gold moves, the wise listen. When silver surges, they pay attention even harder. History proves it, patterns confirm it, and the markets whisper it every day. Gold and silver are speaking, Joe. Are you ready to listen before the next crisis hits?